Good day, I'm Viv Govender and welcome to Nora Ransford's Weekly Wraps. As usual, what we'll do is go over some of the stories that affect you and your investments of the last week or so and wrap up with a little AI/tech segment at the end. Our three stories this week are going to be as follows. The state of the platinum market, the latest round of Chinese stimulus, and finally we'll do a bit of a deeper dive into bonds, especially considering the fact that the US 10-year bond yield, yet again this week breached the 5% level. And in our tech segment, we'll just look at some of the earnings that have come out this week, from companies like Meta, Alphabet, and Microsoft. So let's just start off with the platinum sector. We've seen platinum prices, under a great deal of pressure over the last little while. In fact, effectively over the last, I think 5 or 6 years or so, these prices are unchanged, and from peaks that we saw, a few years ago, they're more than 50% lower, so less than half the price of the peaks. And why is the problem? Because in South Africa, platinum is a huge source of export, valuation in the country. We are pretty much the remaining largest producer of platinum in the world. Our two major competitors, which were Russia and obviously Zimbabwe, both of which have their own issues. And so platinum technically should be our, in our domain, our jurisdiction. And unfortunately, the price of the commodity has fallen dramatically, like I mentioned. In fact, we had results of an announcement this week from Sibanye, that they were looking at cutting maybe as many as 4,000 workers from their platinum operations just because they're not making enough profits, or in some cases, they mentioned some shops are just uneconomical at current prices. Now, what's the problem with platinum, and why do I not advise to go out and start buying some of this stuff? Well, over the longer term, platinum has a huge negative, attribute, and that is it's used for the biggest single source of demand for platinum. Almost half of the demand for platinum group metals effectively comes from at catalytic converters or the automobile sector. These are these things that you put in your exhaust system to make the exhaust that comes out of your car cleaner. Unfortunately, if you go and get an electric vehicle, you don't have an exhaust, and therefore you don't need this particular thing, the catalytic converter, and therefore you don't need as much platinum. And obviously you all know that over the next decade or two, we're going to see a huge uptick in electric vehicles in some parts of the world, especially in the more developed parts of the world, like Northern Europe and places like California. They're looking to ban the sale of new internal combustion engine vehicles by as soon as 2035. We're talking 12 years from now. So that's number one. Number two is the current stock of platinum in the world, in these catalytic converters that are currently out in the system at the moment, is not lost. It's not like you need to continually fill up new platinum into the system. Because platinum is a very expensive metal. There's technology out there to recover it from catalytic converters, and current practices recover about 50+%, 60% or so of the platinum in these catalytic converters, and that's using, in some of the cases, quite old technology. The newest advances in terms of recycling has pushed this number up above 95%. At the same time, efficiencies in the system mean that they use less platinum group metals in these catalytic converters over time. So if you have the current stock of cars, which more likely is going to be decreasing over time because of the adoption of electric vehicles, providing you with their platinum, almost 100% recovery, 90+%, like I said, with most advanced technologies. And at the same time, the smaller new vehicles that you're making, the small number of new vehicles that you're basically producing, always require less platinum because, they're getting more efficient at using it. That's not exactly a great market to be a miner in. And so I do think that kind of makes sense that platinum is under pressure at the moment. That being said, you must know that historically, whenever you have a commodity that goes totally out of fashion, effectively, generally production ceases before demand ceases, and so you tend to find that near the end of the usage of the commodity, prices do tend to rise, even though the producers may be out of business. It's the fact that there's no supply out there that means the prices do tend to rise. So that might be something that we'll see down the line in platinum. The next thing is looking at what's happening in China. And effectively, China has decided to go out and just pump more money into the system instead of fixing its problems. That's the long and short of it. What the problems in China are numerous, and many of them are structural. Unfortunately, the government does not want to go out and really do the kind of things that are necessary to resolve these structural issues. And they are looking to actually just pump more money into the system. Now, pumping money into the system is not a bad idea if there's some kind of reason for it to slow down that's not structural. If you have a cyclical slowdown because of business cycles and so on, yeah, you can put some money into the system, it brings things back to normal. But when you have like a structural issue, it's not going to help. It's like, imagine a body. You put adrenaline into a healthy body, you run a bit harder. You put adrenaline into a body where the leg is broken, it's not going to do much to help that. And the same thing is the situation happening in China at the moment. That system is broken. They have a third of their GDP tied up with property. Property is falling dramatically for a number of reasons, overinvestment plus demographic issues. They have the government's hand, the government's fingers, all these pies that are, not helping in any way. They have really messed up in terms of finances in a number of the regional banks, especially, often to do with the property sector, but other reasons as well. These things need to be resolved, and unless they are, it's going to hamper the Chinese economy, for a while. The example I use is Japan. Japan has had, issues with this banking sector for decades, and it's one of the reasons that we've seen the Japanese economy stagnate for multiple decades. So yeah, stimulus coming in, short-term positive for the market, but longer term, unless they solve the structural issues that are involved in the Chinese economy, the structural problems in the Chinese economy, this is not going to have a long-term impact. And finally, let's do a deep dive into bond market. Now, we discussed bonds in the past, and I want to bring it up again because it's going to be a theme, in the next little while. I think it's very, very important, for most investors. You've got to keep in mind that this is something that's going to be happening for many, many years to go. Now, what's the situation? We've come to a point where a number of developed countries are having declining working age populations. That means a lot of people out there are falling, who are working, basically, are falling. So even though some places have not yet seen a declining population, but the kind of number of workers is falling. Next thing is that we are seeing a return to really high spending. Maybe it was COVID, maybe there's other factors, but for whatever reason, governments now are much more willing to spend than they were in the past. In fact, if you look at the US, for instance, you saw that the Republicans, who were normally the don't spend party, are just as willing to spend right now as the Democrats. Nobody's out there basically preaching austerity and so on because it's not politically popular. And added to that, we have an increase in uncertainty in the world, especially in places like the Middle East, in Eastern Europe, etc. These things are basically causing the cost of borrowing money in certain parts of the world to rise dramatically, even beyond like the 5% we are seeing for the US 10-year bond. All these factors coming together means that we are seeing a situation that we haven't seen in a long, long time in the world. A situation where bond yields are very high, where places that are, focused on growth and need to borrow money to that are going to face real issues. For the last decade or two, if you wanted to grow something, you could grow at any rate almost, as long as you were growing, because bond yields were virtually zero, and therefore you could borrow money for free. So if you could borrow money for free and you were growing at even 1 or 2%, it was still worth to borrow the money because you pay back your capital and you have the 1 or 2% growth minus a little bit for yourself. However, when interest rates in the US 10-year, which is effectively the risk-free rate in the world, is at 5%, you need to grow above 5% in order to justify your existence. If you don't, then someone would just rather, instead of lending you the money, lend the government to the US the money. They are safer, and that'll be the preferred investment to be made. Things that are focus on growth are things like the tech sector, but also emerging markets. Think about it, even places like South Africa and Africa, parts of Asia and so on. These places all need to grow at 5+% a year in order to basically get their countries out of debt, to break the cycle of poverty, etc., etc. If interest rates were like 5-6%, yeah, it kind of makes sense. You grow 5+%, you add a bit of inflation to that, you can pay a debt, no problem. If, however, you are sitting in a situation where you're growing at say 5 or 6%, and suddenly your internal inflation rate is basically whatever, and then you have to that you have having to pay back this massive debt, it becomes much more risky for you to operate. If you're in a situation, for instance, like you're a country like, for instance, Nigeria or South Africa or wherever, and you want to finance your growth in the future because you have a lack of infrastructure. If you have to borrow when the risk-free rate for the US is 5%, your rate is going to be significantly higher than that because you're not the US. You're a developing country, you have a higher risk profile, your interest rate is going to be significantly higher. And that means that when you basically get a new project going, unless that project returns a lot of money, unless your economy remains incredibly stable, if something does happen, you could be faced with a 10% interest rate payment on massive infrastructure projects, which could totally mess up your budgets. And we saw something like this happen in the 1980s, where many poor countries were effectively in a situation where they weren't able to grow fast enough to pay back their debt, and they would often have interest payments that were larger than things like, for instance, the healthcare budget or the education budget. Sometimes healthcare plus education was less than the interest payments, the debt servicing payments. This is a situation that obviously was not good for these countries. And in fact, in the 1990s, there was a thing called the debt jubilee, where they tried to get forgiveness for these debts, because these countries were just never able to repay the debt because they were effectively a debt spiral. And that is the situation we are facing again, because interest rates are rising, and many countries out there who require, or have required in the past, huge amounts of borrowing in order to survive, have not grown enough and will not be growing enough in the future sustainably in order to pay back that debt. And also, this doesn't just apply to the poor countries. Some of the rich countries as well are also in trouble. The one country I think that we need to worry about the most is Japan. Now, the Japanese government has borrowed a huge amount of money over the last while, because the Japanese effectively are a couple of decades ahead of the rest of the world, and not in a good way. They are older. They started this whole demographic stuff before anyone else had it. They have a huge amount of debt, which they are not likely to ever be able to repay. And they can't afford for interest rates to rise, because that debt suddenly becomes incredibly expensive to service. So the Japanese government has what's called a kind of like a line in the sand. The central bank of the German, the BOJ, has the kind of line in the sand. They don't let interest rates go above 1%. Whenever they do, they kind of step in and become an unlimited buyer of bonds. And that effectively limits the ability of the bond prices to go very high. So what does this mean? This means that the Japanese government, okay, is effectively being able to borrow money from their own bank at like 1%, okay, maximum. This doesn't work long term. It's called monetizing your debt. It's a well-known problem that central banks have always faced, where it becomes a situation where the government wants to spend, can't spend because they can't get the money from taxes and so on. What do? They make up these bonds. These bonds are basically bought by their own internal central bank, and the central bank basically is able to finance the government. How is it able to finance the government? By printing money effectively. That devalues the currency, and over time, that's always leads to ruin. Places like Zimbabwe and so on, Argentina have all done this stuff. It always leads to ruin. And what we've seen now is something similar happening to Japan. Now, Japan hasn't quite gone that far down the road yet. It's still a major developed country, and therefore we are still seeing that people are still willing to buy the yen and so on. But the yen has weakened dramatically over the last little while. Look at the weakness in the yen. I think part of the reason for this is people are starting to understand that over time the Japanese yen is going to have to face some real issues, and that government is going to have to do a couple of things. They're going to have to raise interest rates, pay back some of that debt, do something. But it's going to be very difficult because they have a shrinking population. They don't have enough young people working out there to create the productivity, to create the money, pay the taxes to be able to pay off this debt. And the central bank effectively is starting to lose control over the market, because in the last month, I believe, more than once a week, the central bank of Japan had to step in and intervene in the market in order to ensure that rates don't rise too high. That's not a sustainable part of the future. And this is going to be what's going to be happening in other parts of the world as well. We've seen reports over the last few months or so, the last couple of years or so, which discuss the fact that the majority of countries in the world are going to face real issues in their ability to pay their debt because of the fact that they have declining demographics. That means there's fewer people working, and therefore less ability to raise taxes and less ability to basically service the debt that they have. And in fact, may cause them to borrow more money because they have to basically take care of a whole bunch of old people without the young people to support them. And I think this is something to be concerned about going forward, and might be one of the major themes over the next couple of decades. And that brings us to talk about the future. It brings us to the tech little segment. This week, what we'll do is we'll cover a couple of tech companies and what's come out in terms of the latest earnings. The companies we'll cover are Microsoft, Alphabet, and Meta. Now, Microsoft was the only one that the market looked at favorably in terms of the releases that came out. In fact, that share price jumped up a little bit, even though the market overall was negative for the day after we had the earnings come out. Microsoft seems to have gotten a bit of their mojo back. I mean, those of us that are old enough would remember that there was a time when Microsoft was the dominant tech company. It was before Apple and Amazon and Google and so on. rose on the scene. Apple, of course, still existed, but it was like a nothing compared to Microsoft. And there was a period of a couple of decades under Steve Ballmer and for other reasons where they were, basically stagnant. But since then, they've been the most innovative tech company in, I think, arguably for the last couple of years. Their investment in OpenAI may turn out to be one of the best investments ever made. Their movement in terms of, getting partnerships with Meta and NVIDIA and so on, also very interesting. So the market liked their results. Google's, such Alphabet, also came with results. And on the face of it, they looked pretty strong. I mean, we had higher revenue, we had better than expected earnings, etc., etc. The cloud business, however, was under a bit of pressure, and the market did not like that at all. We're talking about almost a 9-10% fall in the day after that. Yes, the market was negative, but it wasn't down 10%. Okay, so the market did really not like Alphabet's results, even though, like I said, they beat on earnings, they beat on revenue, they beat on a number of different things, except for a couple, like, nitpicky things like, for instance, cloud and computing and so on. But the market basically punished them quite significantly for that. Then we also had Meta results coming out. Meta basically also showed a significant beat. The market is a bit confused after market about that. We know it usually rose, then fell. I do think that Meta's results were to be expected. It's the most profitable quarter in quite some time. What they've done effectively is just gone back to the norm, Instagram, Facebook, those kind of things. The experience with Threads apparently is still ongoing. For those who don't remember, Threads is the Twitter killer that they created. Or X killer that they created in order to fight Twitter/X. Did like 100 million in terms of sign-ups in the first couple of weeks, and since then has done nothing. According to Meta, they have about less than 100 million average monthly users, which is less than half of what Twitter has, which kind of is like very disappointing considering the fact that we look at Facebook and look at Instagram, they have many multiples of more average monthly users than that. And you would think that if Threads was a viable product, that you would be seeing that some kind of bleed over from Instagram and from Facebook into Threads. I mean, easily, if you take maybe a 10% conversion rate, Threads would be more than double the current size. Okay, so that's a bit of thing out there. But they are focusing on, they'll discuss also their AI investments. For those that don't remember, Facebook is employing a bit of a different strategy. They're going open source in order to set the standard, whereas everyone else basically is closed. So Facebook is releasing its models to the public. It's doing a number of things there to help facilitate an open source AI ecosystem. Whereas, for instance, OpenAI doesn't even tell you how big their models are. Forget about releasing to the public. And so, yeah, that has been the latest news. What I want to take from this is that some of these results were not that bad, especially Alphabet. The market really punished it for results that I think were not that bad. And what it may indicate is the market is a bit nervous now, but tending towards the negative side. It's looking more like look at the glass half empty as opposed to the glass half full, especially in the tech sector. We've seen massive pullbacks for Amazon, for Apple, for Tesla especially, Alphabet and so on from their recent peaks. Still, most of these companies are up for the year, partly driven by the AI hype around it. But right now, I think the market is a bit nervous about what this current situation is in the tech sector, especially, like I said, because interest rates are high. Growth stocks are really not going to be rewarded as they should be normally when interest rates are low. And so I do think that beyond just the numbers we saw, the fact that the market reacted negatively to numbers that were neutral to slightly positive does indicate maybe a little sentiment change against the tech sector at the moment. Okay, that's it for this week. Thanks for coming along, and I look forward to speaking to you guys again next week. Cheers.